All right, everybody, welcome. So this is our monthly meetup, the first Sunday of every month at 3 p.m. Pacific time. And this sometimes the topic is sometimes there is no topic. We just get together, we talk, anything that comes up. Um, this month the topic is why investing is essential for your financial future. Now, so some of the biggest reasons that that investing is essential is to help grow wealth, to help generate passive income because nobody ever knows what's going to happen. People can lose their jobs. We've had a period of pretty good economy despite like the Great Recession, despite the 2020 recession. Our economy has been pretty good and unemployment has been, fairly low, but there may come a time when you lose your job, when you don't have an income. And times like that is when it becomes crucial to have something in the background, something paying your bills. Because you can't really rely on the government. You can't rely on family. You really have to be there for yourself. You have to be the one to take care of yourself, right? So I saw this. This is a little old, maybe from like 2012 or something like that. But look at that ad. It's a couple of people who should by all means be retired at this point, but they're welcoming people to work for them as McDonald's. If I'm ever so penniless that I have to work in retirement for McDonald's, I've done it wrong. And so that's why investing is so crucial. So investing also, when you have just cash in the bank, it loses purchasing power to inflation. And so when you invest, you tend to grow the money past what inflation will eat away at it, right? So like if inflation is 3% on average historically, and investing, if you invest in stocks or in the S&P 500, for example, you'll get about 8 to 10%. So it kind of outpaces inflation. That's one of the reasons why investing is so strong or so important, right? And the last 2 points there: build a strong financial future. I feel I've covered that, and help the world. So I feel it's important that most of us were just thinking of getting by, of our own family, our own financial future. But I think it's important that once you have achieved a measure of success, that you give back, that you donate to charity, that you help the world in some way. And so that's what investing can do for you. Right? One of my friends who's also on this path to financial independence, he says, you love your job, so why should you invest and worry about retirement? Because one day, maybe even next week, that could change, or you could be forced out of that job. Just start investing. You don't want to be these people, right, who are forced to work at McDonald's when they should be enjoying the golden years of their life. Another quote that I really like is, wealth is the ability to fully experience life. So too many people conflate um, wealth with being able to buy stuff. And it really shouldn't be. The point of money is not to be able to buy stuff. It's to fully experience life. It's to have safety and security and to be able to spend your time really how you feel you should. Right? And I think you guys already know this, but investing is sort of like planting a tree. You need to use money that you receive, like from your 9 to 5 or from some other source, and plant those seeds, plant those dollars to grow into a massive tree that produces more dollars for you. And what I was talking about earlier, financial freedom, it's not about buying stuff. It's about having the freedom, right? So here are some good quotes. I like, when your passive income exceeds your expenses, you've reached financial freedom. And I think everybody is kind of looking for that, to where your investments cover your bills. So you don't have to worry about working, right, to pay the bills. And that's how I got started in this. A little over 10 years ago, maybe 12, 13 years ago, I got started investing um, to be able to escape having to work a job. And I like my job now just fine, so I'm going to stick with it for now. But you can never be too careful with how much money you have, right? Um, so let's go into some investing do's and don'ts. Do live below your means and save and invest the difference. You do want to invest early, and you do want to invest often. So it's important to prioritize saving part of every paycheck and investing that as early as you can. You also want to diverse. Let me see if I have some pictures here for you. Yeah, so it's important to invest because if you just keep the cash, the money won't grow very much because it tends not to keep up with inflation if you put it in a savings account, which is why you have to invest it. So you have two people here, Victor and Vanessa. They both saved $500 a month, and Victor saved his money in a savings account, in a high yield savings account, which ranged here. And then Vanessa invested her money in an S&P 500 index fund. So that's a stock market index fund, right? And today, and this is for the last 35 years, so over 35 years, Victor was able to save about 316,000, and Vanessa was able to grow her money to 1.5 million. Right? Like I was talking about the consistency, right? Investing is a lot like exercise. You do it one time, and probably nothing's going to change, but you do it consistently over and over again. Every paycheck, you set some money aside, and it will change your life. Okay. So the next part is diversify. So we're going to cover that in a little bit, but it's important not to put all of your eggs into one basket. So I know many people who, well, I know one person who put all of his money into GameStop back in 2020 when it was a meme stock, when it was going to the moon, right? He put all of his money in there. But now that money is, I mean, it's still there. He still owns the shares, but it's not as much as it was, you know. I put a little bit of money into crypto, and people were like, no, put more, put more. I'm like, nope. I put in $1,000 into Bitcoin. I put in a thousand into like Ethereum and a couple of other cryptos. I put a little bit of money in, but with the idea that this was a speculative move. It was kind of like a lottery, a gamble, you know, like a lottery ticket, right? So it's very important that you diversify, right? You don't want to have all of your money in one investment. We'll talk over this a little bit in a little bit, but next, you want to invest in what you understand. So you never, here's something that where are we? Never invest in something you don't understand. Trust me, bro, not a valid investment strategy, right? So yeah, just invest in something you understand. So many people have lost money by jumping into something because somebody told them, oh, you should invest in this because I heard from this guy who heard from this guy that's going to be huge. Or you're listening to the financial news, or, you know, it could be a bunch of stuff, right? And so invest in what you know. This is how Warren Buffett invests. And he's something like the third or fourth richest person in the world. So only invest in something you understand. You also want to invest for the long term, and what that means is you don't want to be jumping into different from investment to investment, from investment advisor to investment advisor. When the market crashes, you don't want to like switch your allocation. You really need to invest for the long term. If you're going to invest in something, make sure you're investing for a good reason. Like I invested, so my recommendation for what people should invest in is generally just like an S&P 500 index fund or a total market index fund. For 95% of people, that is the best way to invest. It's simple. It's fairly guaranteed historically. You know, in the short term, the stock market can do very poorly. You can lose a lot of money in the short term, but you have to invest for the long term, you know, and you have to invest based on your risk tolerance. So like somebody so stocks are fairly risky in the short term, but they're fairly safe in the long term. Not single stocks, because individual companies can die out like that. You know, something bad can happen. There can be fraud. There can be, you know, Beanie Babies, for example, the Tyco that was making Beanie Babies, they were huge back in the day. But then when the demand crashed, you know, the company also cratered. Companies like Enron, companies like Bear Stearns, Lehman Brothers, all that stuff, they were huge captains of industry back in the day, but then something happened and they died. So you always want to diversify. You don't have all of your money in one thing. And you want to buy, if you buy a company, hang on to it for 20 years. You know, don't just buy so you can sell tomorrow. You know, in the same way you would, if you would buy like an apartment building, you wouldn't sell it tomorrow because the price went higher. No, you would hang on to it and collect the rents, right? Same with stocks. If you buy stocks, hang on to those stocks. Know why you're buying that company and collect the dividends and use those dividends to, you know, buy some more. And so your risk tolerance, right? So a young person, somebody who has many, many decades ahead of them, they would do well to invest in things that could fail spectacularly, like stocks or like real estate, you know. But somebody who's like 80 years old, who doesn't have a lot of money, they should not put all of their money into something speculative. They shouldn't put all of their money into like stocks, you know, because they might only have like 5 years to live. So really like invest based on what your risk tolerance is. If you're younger, do something a little more risky like stocks. And if you're older, do maybe some bonds, maybe some gold. We'll cover that in a little bit. So the next one, do invest in tax advantaged accounts first. Now, what do I mean by tax advantaged accounts? Tax advantaged accounts are accounts like your Roth IRA or a traditional IRA, your 401k or your Roth 401k. Now, these are accounts that allow you to either not pay any taxes or to defer your taxes to when you retire, and at which point you can find strategies of not paying any taxes at all. Right. So investing has much better tax treatment than earned income does. So yeah. And then the last one, be careful with debt. Do be careful with debt. If you don't need to use leverage, don't. Like there are entrepreneurs out there who do very well with investing with borrowed money. But for 95% of people, I'm kind of taking that number off the top of my head, but it's a lot of people. For most people, they see the big numbers. They see, oh, I can borrow money. And if like, let's say, I have $100,000 and I borrow another $100,000, if that investment made me 20%, if I put in just my $100,000, I'd get back 20,000. If I put in somebody else's borrowed $100,000, all of a sudden I have a 40% return. After giving them the money back, I have a 40% return. But the issue with leverage, with debt, is that it's like a knife. It can be very useful, and a lot of people use leverage to invest, and they do spectacularly well. The problem comes up when the investment doesn't go how you had planned. Now, all of a sudden, not only do you not have the money that you would have made, but you also have to give. You not only like say that investment loses 20%, right? So your 100,000 is now down to 80, right? And but you didn't just put your money in, you put in somebody else's money, right? You borrowed 100,000. So now not only, what is it? So it's now 160,000, right? So now not only do you have to take that 160 and pay the person back their 100, but you're only left with 60,000. So you lost 40, about 40% loss. That's what leverage does. So it can be useful. It's like a knife. It can be useful, but if you're not careful, it can cut you. So be very, very careful with debt. And so we talked about saving versus investing here. We talked about investing consistently. You really want to prioritize with every paycheck. You want to live below your means, and you want to prioritize saving. And assuming your debt is all paid off, you want to put that money that you saved into investments, into the stock market, or into real estate, or into bonds, or whatever it is that that you understand. Right? Invest in what you understand. Another one that I kind of skipped over here, keep your fees low. You want to keep your fees low. Now, there's a million and one people out there who will tell you, oh, I'll teach you how to invest, or I'll invest for you, I'll make you all this money. By and large, you don't need those people. They charge you a lot. They tend to add fees to your investments. And most people, like literally 95% of the population, would do well just to have low cost index funds. They don't need anyone managing their money. Some people do because they're wealthy and they have special trusts or special situations. There may be estate planning, or it's good to have a lawyer, a CPA, something like that, right? But for most 95% of the people, you want to keep those fees low. You want to avoid these investment managers because they tend to charge a lot. Let me give you an idea of what that looks like. So an index fund is a passive investment. All it does is the fund manager takes the list of, let's say, the S&P 500, which is the 500 biggest companies in America. It sees that list every day. It says, okay, these 500 companies I need to buy for my index fund, for the S&P 500 index. And Vanguard, which is a company that I really like, they charge 0.04% annually on your money. Now, all of these funds, all of these investment funds are going to charge you something, because they are the ones who put all those together. So instead of you having to go out and buy 500 different companies, they put it all together nicely into one package for you, right? That's what an index fund is. It copies the stocks on an index. Could be the Dow Jones Industrial Average, could be the S&P 500, could be a total market index fund, right? That's a index, right? And they don't charge very much because they're passive. Compare that with an active mutual fund. And an active mutual fund is where the fund manager says, well, I have a PhD in economics. We have a bunch of quantitative analysts. We have algorithms. We have computers finding the best stocks. We know when to buy and sell. They do, but they charge you a lot for that. And they tend to, like active mutual funds, tend to charge you 1 to 2%. And if you're thinking, oh, 1 to 2% isn't bad, I'm making 8% or 10% a year or 20%. 1 to 2% isn't bad. But if you compare that, look at this. Somebody who had invested $10,000 in an investment returning 10% before fees for 40 years would have $446,000. But somebody who gave that $10,000 to an investment manager charging them 2% would be less than half that after 40 years. So these fees can really add up. So that's why I say keep your fees low. Keep your fees low. Just go with a passive index fund, low fee, low cost, and use that money to invest. And that's not just like index funds or mutual funds. There's a lot of other unscrupulous financial product salesmen, shall we say, that will sell you stuff. They will sell you insurance products. They'll sell you annuities, which, by the way, annuities, if you're not retired, you don't need an annuity. So just FYI for future reference. And most people don't benefit from insurance policies with an investment component. Insurance should just be that, like your car insurance. You would not invest through your car insurance, so you shouldn't invest through your life insurance. Anyway, sorry, that was kind of a tangent, but yeah. But yeah, keep your fees low, right? And here's another example of what could happen. So this person invested $500 a month in a low fee index fund, and compared to a mutual fund and these are actual returns, by the way. This is what the market actually did between 1983 to 2002. So this person that invested $500 a month for 40 years, they had at the end 2.8 million, 2.9 million. And then the person who invested it in a mutual fund that had a 2% fee, they had less than half that. So another lesson to learn from this is investing only $500 a month for 40 years, you can have close to $3 million. That's how crazy the stock market is. That's how good the US stock market has been. And that's also, it goes to show like what compounding can do. And here's just another example. Yeah, $10,000 invested over 40 years, like a very low fee compared to a 2% fee. So this 2% fee eroded 55% of the investment. All right, so now we went through all the do's, right? Live below your means, prioritize investing and saving, invest often, invest consistently, diversify, invest in what you understand, keep your fees low, invest for the long term, invest based on your risk tolerance. Like if you're old, don't invest in don't invest in crypto, right? If you're young, feel free to invest in crypto, invest in stocks, but keep it diversified. Don't dump everything into one thing, and be very careful with debt. Now onto the don'ts. Don't invest in things you don't understand. I think that's kind of like the first one too. Yeah. Don't jump from investment to investment. Like I've talked with so many people, I've had to talk them down from ledges. Like, oh, my investment is down 20%. Yeah, Sheila, it's because the market's down, like be patient. If you invest in something, be prepared to not touch it for 20 years. Okay. Know why you're investing in something, and don't jump from investment to investment. Don't jump. Like if I give you advice, don't be an asshole and like go ask somebody else and take their advice. You have to know what kind of advice you're taking, and you have to stay with that, because jumping around, moving your money around from investment to investment is a great way to lose money, to end up with not very much, you know. And don't chase performance. Like what some people do is they have their money in some fund, you know, more often than not with high fees. And they see, oh, you know, 2022 was bad. My investment lost 15%. So I'm going to go, I saw this fund over here actually gained 10% during 2022. I'm going to jump into this. Now, what they're not looking at is why did that fund gain, you know, 10%? It's because they were contrarians. They were investing in things that go down, up when the stock market goes down. But the stock market goes up 3 out of 4 years. So would that be a good idea for you to invest in regularly? Something that goes up when the market goes down? No, because the market goes up most of the time, right? So that's, you can't jump from fund to fund, right? Make sure you know what your strategy is. Make sure you know why you're putting your money in something, right? Don't speculate, don't day trade, don't make short-term decisions, right? So we all want to get rich quick. You know, I'm not going to lie. I want to get rich quick. I've been wanting to get rich quick for 10, 20 years, you know. I've been wanting to be rich overnight, 20 years, but that just doesn't work. Get rich quick is a great way to lose all your money, you know. Um, don't needlessly interrupt the compounding process. So basically, there are people who think they see the market go up and down and up and down. They're like, oh, I should just buy when it's down and sell when it's high, and that way I have more. Well, the problem is that nobody really knows what the market is going to do, right? So you can't. I'm just going to tell you straight up, you can't time the market. You know, you are a terrible investor. Most of you in general. This is, you know, we as people are terrible investors. We don't know what the market's going to do. That's why you kind of hitch your wagon to the economic output engine that is the American economy. You just buy an S&P 500 index fund. You basically invest in the top 500 companies, and you trust that over 10 or 15 years, you're going to make some good money, right? Don't needlessly interrupt the compounding process. If you put money into your Roth IRA, don't pull it out. It's in there. Let it go. Let it sit there for 40 years. You know, don't pull your money out of your 401k. Don't pull the money out of the market and then say like, okay, when it crashes, that's when I'm going to invest, because you don't know what's going to happen. Okay. And don't invest in something just because somebody else is investing it or because somebody else told you to, right? So a couple of years ago, I was working in a UPS warehouse, and I had a buddy who was all in on crypto. And I had some money in crypto, but it was a very small amount. I only invested outside of index funds once I had $200,000. Then I took 10%. I put some in Tesla. I put some in Bitcoin. I put some in Amazon, like a few other like side gambles, right? But that was only a small percentage of my whole net worth. The bulk of it was always going to be index funds, always going to be S&P 500, always going to be total market index funds, right? So don't believe, if you invest in something based on something that somebody told you, you know, you really have to know where they're coming from. You know, they may, because this was a warehouse worker, right? What does he know about investing? And you know, of course, all the crypto got lost, you know, and so he feels pretty bad right now that he put all of his money into there. So diversify, put it in something. Don't put it into speculative things. You know, I see all kinds of stuff on Facebook with like they're trying to push art, like art as an investment to regular people. And I can tell you that is a terrible idea. The rich invest in art, sure, but that's only as a small fraction of their overall portfolio. Most of the rich, what they do is invest in businesses. They invest in these stocks. They invest in bonds. They invest in real estate. You know, they invest in things with some cash flow, things that produce an income, right? The crypto, art, gold, stamps, any of that stuff, that's all speculative because it's worth what the next guy will pay for it. Whereas something like stocks, something like you buy a ownership portion of a business, you have earnings. You know, you have profits that the company produces, right? So yeah. So just don't invest in something just because somebody else is doing it, right? And finally, don't invest in your non-retirement accounts first. For example, like a taxable brokerage, accounts like a crypto, anything like that, you always want to max out your retirement accounts first, because you can get the same investments in your retirement accounts as you can in your taxable accounts. But why would you pay taxes unnecessarily, right? So always invest through your Roth IRA or your traditional IRA and your 401k, either your Roth or your traditional 401k. Yeah, so this is, never invest in something you don't understand. Trust me, bro, is not a valid investment strategy. Okay, so remember how I was talking about this? There is no get rich quick. I'm sure, I'm sure we all know somebody who is always jumping on the next big thing. They're kind of an entrepreneur at heart. And you've seen them do this for 10, 20, 30. Maybe some of you have seen people do this for 40 years and they're still broke. That's because they're always trying to double their money by next weekend, when you really should be thinking, how can I double my money in 5 years or 7 years? That's more of a reasonable doubling, right? So investing is a long-term game. Trying to get rich quick is a really good way to stay broke. Another thing to keep in mind, anything that has a very high return also has a very high risk of loss. So return is the reward that you get for taking on an amount of risk. So like if you put your money in US Treasury bonds, risk is virtually zero, because the only way you wouldn't get paid back is if the US government defaults, which is unlikely to happen, right? It's one of the most trusted investments in the world. Like even foreign countries invest their money in US Treasury bonds, right? Or a savings account. A savings account is very low risk, because unless the bank goes bankrupt or whatever, your money will be there, and so you'll get paid back. And that's the reason why savings accounts don't pay that much. On the other hand, you look at those crypto investments, they had sky high rates of return, and that should have been a red flag, because high return equals high risk. Low return, low risk generally, right? And you can kind of get that alpha, like that return beyond what you can get in the stock market, by taking like outsized risks. But you just have to make sure that these risks won't wipe you out. I took small risks and I did very well with these side gambles, these small risks. But I didn't put all of my money in there. I stayed diversified. I always was aloof. I never like jumped in with both feet, right? Always for me, index funds were the core, the principal investment that I had in my portfolio. Right? And this is what I was saying. You don't want to get rich quick. You want to get rich slowly. You want to invest consistently in diversified, low-fee index funds. And this isn't for everybody, of course. Some people might invest in real estate, or some people might invest in other things. You want to invest in the things that you understand. But this is my recommendation. This is what I do. And this method works for like 95% of people. So instead of chasing the next hot thing, like your entrepreneurial buddy who never made it anywhere, the next big payout, the next lottery ticket, you should invest steadily. You buy stocks, you collect those dividends, and you use that money to buy more and more, and you allow compound interest to work and build your wealth, and then you get rich slowly. Or you can buy real estate and let the rent roll in, you buy more and more and more, but that's how, the compounding effect works. And so remember how I was saying that these, we have your Lehman Brothers, your Enron, some of you might remember this, WorldCom, Blockbuster, Chrysler. So these people, or these companies, they used to be captains of industry. They used to be on top of the world. Kodak, some of you who are around in the 70s, you might remember Kodak. They were massive companies, but individual companies don't tend to stick around for that long. So somebody who put all of their money in Kodak wouldn't have that much money today, right? So you have to diversify. You got to put it in a bunch of different baskets, a bunch of different eggs, right? Not just a single egg in one basket, right? Yeah, don't pick stocks. Don't chase performance. Don't try to time the market. And don't interrupt the process of compounding unnecessarily. And to think you'll sell and reinvest at lower prices is a fool's game, like I was telling you guys. So check this out. So you might be thinking I'm lying, that you're smarter than the market, you're smarter than me, you're smarter than all the other millions of participants. But I can tell you that millions of people think that way, And the S&P 500 between 1998 and 2017, it averaged 7.2%. Historically, it's actually closer to about 9%, right? So this 2017, this included the Great Recession when the stock market crashed by 50% in 2008. But the average investor who does chase performance, who does pick stocks, who does jump in and out of the market, they made 2.6% in that timeline, right? Whereas somebody who just put their money in an S&P 500 index fund, they would have had 7.2%. Right? So be patient, invest for the long term. Do not think you're smarter than the market, because you aren't. And another cool, interesting study that I found was Fidelity, a large brokerage company, investing company. They did a study, and they wanted to see, out of all of their accounts, of all of their brokerage accounts, which type of investors did the best. And number one was people who were deceased, right? People who had no access to their funds and had no way of moving stuff around. Number two was people who had forgotten they had an account. So similarly, they couldn't access it. So regularly investing without routinely buying and selling based on whatever the news says, and you want to ignore the news, forget what the news is saying. You don't know where they're coming from. You don't know why they're telling you this. They might have a rich buddy who tells somebody on CSNBC or MSNBC, hey, tell people that, I don't know, Tesla's about to crash, so everybody sells and get out. And the whole point of that was so he can come in after all the stupid money had gone down, had made the stock go down. They can come in and buy it for high prices or for low prices. So you don't know what purpose or why they're telling you these things on TV. So it's best to just ignore the financial media, because it's like the Jim Cramers, because half of the time he's wrong. So just don't ignore it. Just consistently invest month after month, paycheck after paycheck, year after year, and in 20 or 30 or 40 years, you'll be wealthy. This is what I was talking about with the Roth versus brokerage. Invest in the man, this is kind of out of order. Invest in these non-retire, or don't invest in the non-retirement accounts first. Invest in your Roth IRA first, your 401k. So if you compare somebody who put the same amount of money into their Roth IRA versus a taxable brokerage account, so somebody who did the taxable brokerage account had to pay 15 or 25% in income tax on the dividends, whereas somebody who just kept their money in the Roth IRA didn't have to pay anything because it's tax-free. And capital gains are when you sell a stock, you pay taxes on the profits. If it's in a taxable brokerage, it can be 15 or up to 20%. And if it's in a Roth IRA, it's just, it's zero, because it's tax-free. So you see how this person had about $600,000 more than the one who just did in their taxable brokerage. So always try to do your taxable or your tax-free investments first. All right, so I asked ChatGPT, what are some reasons that people should start investing young? And these were the 6 reasons that they gave, that ChatGPT gave me. 1, time is on their side. Younger investors have more time to ride out market fluctuations and can take advantage of the power of compound interest. Number 2 is to build good financial habits. So investing is really like 10% knowledge and 90% behavior. Like, I could tell you everything you need to know about this stuff. I could tell you what to invest in. I can tell you, anything you want to know about this stuff. But if you don't actually take action, you don't actually save some of your income, because where's the money for investing going to come from? It has to come from your income. You have to set aside part of your paycheck and invest it, so the money is working for you, right? Unless you want to work for your money forever. I personally, I want there to be a point where the money can work for me and I don't have to work for my money, right? Next one, lower risk tolerance. Like, younger investors can typically afford to take on more risk because they can recover. If somebody gets wiped out at 25, that's okay. They have another 10 years to recover, get started again at 35. 35 is still fairly young for investors. You've got another 30 years until 65, until official retirement, right? And number 4, build a strong financial foundation. Anyway, so take advantage, learn by doing. Yeah, so this is what ChatGPT told me. So now I want to talk about why it's so important to start early. And I think everybody kind of gets that, the earlier you start, the more compound interest kind of takes hold. Let's take a look at, let's go with the 8% because that's traditionally what we consider the market as returning. I mean, it's a little more than 8%, but let's just say 8%. If you want to have $1 million by the time you reach age 60, this is how much you have to invest a month. Notice how if you're 50 years old, you got to catch up. There's a lot of money you got to put in. You got to put almost 5,500 in. Go down to 40, it's a lot less. You start at 30, it's even a lot less. And at 20 years old, getting 8%, you have to put in less than $300 a month to have $1 million by age 60. So yeah, it's really important if you can, get started as early as you can. And it's not there to discourage people from starting. If you're already 60 years old, that's okay. You still have years or decades of life ahead of you. So just take the decades that you have in front of you and start applying these principles, start investing, but hopefully by the time you guys are 60, you have something set aside. And as for what to invest in, stocks generally are the best. This is a logarithmic scale. So it's by a factor of 10. So it would be more of a steeper curve, but stocks have done by far the best. So if you invested something 95 years ago, if you invested $1 95 years ago in 1928, that dollar would be worth, it looks something around like $7,000 or $8,000. That's what that dollar would be worth. Compare that to, I don't know, bonds, which do have their place, but they just have a lower return. It'd be less than $100. Gold would be also less than $100, right? So gold is not as much of an investment as it is a store of value. So it maintains its purchasing power, and I'll show you that in a little bit. And then real estate also. Despite what you hear, real estate is a terrible investment if we're talking about your primary residence. So houses don't really go up much faster than the rate of inflation. Recent events notwithstanding, but houses generally are a factor of people's income. People can't afford to live in a house that's not that they can't afford to pay for, right? So houses can't increase by more than realistically the rate of inflation. That's not to say rental real estate. So that's different because people use leverage, they use debt. And so the profits can be kind of amplified with that, right? So, but for the most part, stocks are kind of what you want to do. If you have more than 15 years, you're probably good with stocks. Now, we know that the stock market, this is the Great Recession right here, when the stock market dropped 50% right here. And this is the 1999 one. And then this is the Great Recession here, the 2008, where it dropped 50%. And so it can be incredibly risky in the short term. You don't want to put your money, if you have less than 5 years to invest, you do not want to put your money in stock, right? But if you have a long time horizon, 10, 15, 20 or more years, then stocks are great. And the stock market, take a look at how the stock market has performed. Marcus, can you turn off your microphone, please?
Sorry.
No problem. All right, cool. Thank you. So you see kind of how the stock market has gone up, right? This is what you can kind of expect over time, right? And this is despite, look at all these crises that have happened over the last 12 years, right? You had your Europe debt crisis. You had your fiscal cliff. Anybody remember that? We're about to have another one this year. We had a government shutdown in 2013. We had Ebola. We had Brexit. We had the US election. We had 3 massive hurricanes, 2017. We had government shutdowns. We had Trump's impeachment inquiry. We had COVID-19. How many of you remember that? Back in March of 2020, the stock market crashed 30%. And people were like, oh, this is the end, right? But it recovered. 2021, we had the US Capitol. 2022, we had, I don't know, we had all kinds of nonsense going on, right? But despite that, between 2011 and 2021, the S&P 500 went up by almost 4 times. You know, if you put your money in there, it would have quadrupled almost in that time. And so that's why you have to be patient. You have to ignore what's going on, because stock prices are based, in a nutshell, they're just based on what you can expect to receive from that business. Right? And so remember how I was saying that gold isn't really an investment, it's more of a store of value? Gold tends to maintain its purchasing power. That's it. It doesn't really go up in value. And in the short term, it does. In the short term, it fluctuates, right? Based on how people are buying and selling. But 100 years ago, you could buy a family car for about a kilo of gold. So at the time, it cost $645. Recently, and prices have gone up, I realize that, but notice how the price hasn't changed that much in gold terms. You could still buy a car for that one kilogram ingot of gold, right? So gold does not make any money. It just basically retains its value after inflation. Warren Buffett likes to call gold a dead asset, in that it looks shiny, it sits in the ground, it maintains its purchasing power, but doesn't produce anything. It doesn't do anything. So Warren Buffett doesn't own gold. He owns a bunch of stocks because he trusts that these are live assets. These are assets that are making him money, right? And so gold is one of those things that's great for retirees, people with low risk tolerances. It's low risk, but low reward. So now this is more about how compounding is it's so important to start when you're young. The earlier you start, the more your money will be worth over time. So somebody who started at age 20 and saved $1, by the time they're 65, it'll be worth like $18.50. Every dollar they invest will be 18 times greater. And you see how it kind of drops over time. So if you start at 21, it's going to be something like 17. If you start at 30, it's going to be, you'll basically 10x your money by 65 if you start at age 30, and so on and so forth, right? So you really want to start as early as you can to help amplify the money that you put in, because the later you start, the less your money will grow. I want to show you guys something cool. All right, so this is the benefits of investing early in life. How do I make, oh man, can I not do this? Oh man, let me see. Shoot. Anyway, you guys take a look at, I don't know how to show everything here. I'm going to share this in the chat. So you guys can take a look at it on your own. But basically, it just shows how much of the, I'll press play and see what I can. But it just shows how much of this, the total invested versus the total return. Notice how as time goes on, the gap becomes larger and larger and larger. And it kind of like speeds up, it accelerates away from that line. So this is the amount of money that the person invested. And this is the amount of money they have, right? And if you look here, the money that was invested in their 20s makes up by far the most. It has the most impact. In 30s, it has some impact, but not as much. And each decade has less and less impact as you go on in life, right? Get back to here. Forgive me. Okay. All right. And just to keep beating the dead horse, why you should start investing early. Take a look at this. So this person here started at age 25 and was putting $500 a month. And so she invested for 40 years compared to this person who started 20 years later at age 45, but she decided to put double the amount, $1,000 a month. But this person, despite putting so much double the amount, this person had 40 years to invest. This person only had 20 years, but they still, so she was like, okay, I'll put more, I'll double it. Since I have half the time, I'll double it. But she ended up with about half the amount as her because compounding is exponential, not linear. And yeah, so yeah, start early, put as much as you can as early in life as you can, and you'll be all right. So for those of you who want to know how to retire in 12 years, you need to live on 46% of the money you bring home and invest the remaining 54% in index funds. And if you do that consistently for 12 years, you'll be able to retire. The money will be enough to cover your expenses forever. And let's say, okay, you can't really do 46, you can't save 54% of your income. I get that. Not a lot of people can. I have some years, but it's tough. Fine, we'll bring it down to 50% and you can retire in 15 years. Right? And this is just talking about your Roth IRA. I'm going to skip this because we kind of covered that. It's index funds. Oh, and for those of you interested, here are some index funds. This is just a total market index fund. It's this kind of the simplest. Set it and forget it. Just consistently invest. If you buy one of these index funds, the total U.S. stock market, you're buying basically every publicly traded stock out there. So anything people spend their money on, you'll get a small portion because you own a piece of all the publicly traded U.S. businesses in the U.S. So I have mine in Vanguard. I have mine in VT Sachs. That's the total market index fund. It has an expense ratio of 0.04%, which is not bad. It's about 40 cents a year for every $1,000 you have in the fund. So much better than the 1% or 2% that actively managed mutual funds will give you. And this is kind of an example of what an ETF or an index fund is. So you're buying the jar, and the jar contains small pieces of a bunch of different companies. This is kind of what it looks like. So I promised I would talk about my own investment journey, and this is it. So I grew up, I spent my teenage years abroad in Africa, and I came back when I was 19. And I didn't really know how to live life. Wasn't really taught any of that stuff. So I just like bounced around different like dead end jobs and did stuff like that. But I finally pulled myself out with I had a little bit of debt because I didn't have a good job, and I joined the Air Force, right? And from the time I joined, I saved about half my income. I paid off my debt. And when I was 25, I was out of debt. I had zero debt, and I had something like $5,000 in my thrift savings plan, which is the military 401k. But I continued. I carried those habits over. The frugality. I tightened my belt. I didn't spend anything unnecessary, and I invested that money into the stock market. And from the very beginning, I started with index funds. I didn't really know much about investing, but I just did it anyway. And by the time I was 28, so less than 3 years later, I had 100,000. And at that point, I told myself, you know what? This is kind of a long shot, but I'm going to reach 1 million by 40. That was my goal, from 100,000 to 1 million in 12 years, right? And I was like, I have no idea how I'm going to do it, but it happened. I hit 1 million at 36. And that was at the beginning of 2021. And it's currently less than 1 million because the stock market dropped. So, I mean, stuff like that happens. But it'll go back up. And the reason I was able to go up so quickly, as you can see in the graph, is because I had my side gambles. I had my Tesla that went up huge. So Tesla makes up 29% of my current portfolio. And I only put in like 3%. So it really grew a lot. But that's how I was able to hit $1 million. But you have to be so careful with these side gambles. I'm not saying that that's how you do it. I'm not saying you get rich by buying Tesla. I'm saying you get rich slowly by buying like index funds. And when you're in a good financial position, you can take those side gambles. You can take those risky moves, right? Like I did. Um, and yeah, that's it. So, if you guys have any questions, please let me know. All right, I'm gonna stop the recording, so feel free to talk.